Hello and good morning, everyone. Welcome back to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. I think the big story last evening was Fitch, which is one of the large credit rating agencies globally, which lowered the US sovereign debt rating from AAA to AA plus. JK will decode the implications of this move for us, but before going over to JK, the fight of who out of the Fed may be getting closer, with the ISM manufacturing PMI for the US coming in slightly below expectations. So that was just a quick update on that narrative we are following. JK, over to you. Keen to hear your thoughts on the credit rating downgrade. Will this lead to a broad dollar weakness?
Hey, good morning, Swaraj. Yes, I think that takes major attention of the markets today because the Fitch, echoing a move made by S&P Global Ratings a decade ago, have cut the rating of USA from AAA to AA plus, and I think this was probably on the cards because when the debt ceiling impasse was going on, Fitch had already put US credit rating on a watch, and even after the debt ceiling deal was signed, they continued it to keep it in watch. So, which means that they were not just looking at the debt deal impasse, but they were also looking at the medium-term position of the U.S. Economy in regard to their fiscal position. In fact, they are actually saying that the downgrade reflects expected fiscal deterioration over the next 3 years, a high and a growing general government debt burden, and the erosion of governance relative to AA and AAA rated peers over the last 2 decades. So that's what they have said. And what we can see is that yesterday, despite some underwhelming data from US, like US manufacturing PMI, ISM manufacturing PMI came a little lower. Then we had also the JOLTS data that showed job openings were lower than last month, and these would have normally led to rally in the treasuries, or rather a fall in the yields. But actually what we saw was a rise in the yields in the 10-year, particularly in the 10-year and the 30-year, and steepening the curve. And this was slightly against the market's analysis of the data. And not just the Fitch, it's also the market news overnight was that the treasuries wanting to increase its net borrowing estimate for Q3 to 1 trillion compared to 733 billion that was estimated 3 months ago. And even Reuters notes that US Treasury is suggesting a Treasury general account balances at 750 billion by the end of 2023, over 100 billion more than the consensus estimate. So we have been saying in our many daily updates that despite the data from US, which is showing inflation down and other cooling off in the employment market, etc., the treasury yields have not been going down because of the supply concerns. And these supply concerns have risen immediately after the debt ceiling issue was signed, because they had held back many issuances, and then with higher fiscal deficit they have to borrow more, and when they borrow more and there is no enough buyers, the yields keep going up. So that is what is reflected. Now on to the effect of what happens now. Ideally, today morning, of course, we did have a small rally in the treasuries, or rather the yields fell back slightly. But I think the real impact of this should be eventually for yields to go up. The thin markets in Asia generally don't reflect what's the real analysis of the market. So I expect that yields will go up because not only the downgrade, but also the more supply that is expected from the treasury is going to impact the yields, and this will probably keep the dollar also a bid. And not only that, some sort of a risk aversion when a rating action takes place will also lead to dollar being bought, and that is what we are seeing on the on the markets right now. And as far as the economic data was concerned, as I said, US data was slightly weaker. European data was good in parts, but like inflation was the growth GDP was slightly better than expected. But if you look at the details, Germany was flat, then France and Italy were down, only Ireland was much better. Then inflation, the previous day, which was announced, showed that headline inflation had fallen, but the core inflation was still going up. The retail sales in Germany fell 0.8%, continuing its declining economic activity. So all this did not help the euro, and euro was seen testing 1.0950 overnight before it bounced on the Fitch news. But again, it's not able to cross 1.10. So the overall dollar seems to be quite a bit on risk aversion, and also possible higher US yields, which will probably attract more money into it. But the medium-term view would be that the dollar eventually should come down as more and more people reduce their holdings of the US treasuries eventually. So short-term dollar strength, but a medium-term dollar weakness is how I'm seeing it, because currently the US economy, leaving aside the fiscal position and the ratings, US economy seems to be much better placed or much better performing than most other economies as well. So we also see the Chinese yuan rebounded strongly. Rather, USD Chinese yuan rebounded strongly from about 1% from 7.1150 to 7.19 now, because the data from China is not very much increasing. And also what we are hearing is the Chinese exporters, they're not outright converting their receivables into yuan. They are actually going to the swap route, so that, it's like they're keeping their right to buy dollars. And we're also hearing about reports of Chinese central bank asking the investors and the importers to slow down their dollar purchases. So there is some concern that Chinese yuan may be again on the weakening path, and 7.20 break, when it happens, could lead to higher Chinese yuan towards the previous peaks that was seen in this cycle. Yen, of course, has been the weakest of the lot, because we have seen almost a 5 big figure move from the lows that was seen on the day when Japanese tweaked their yield control policy. But again, 140, we had seen 143.90 high yesterday, and I think closer to 145, the Japanese authorities will get concerned about the currency weakness, and there can be some direct action there as well. Coming to Indian rupee, we had again a very narrow range yesterday. There were good capital inflows were heard, but they were all being absorbed. But later in the day, we did hear about a reported possible repatriation of rupee balances held by the Russian banks with India, and some reports, unconfirmed reports, indicate that this could amount to around USD 20 billion. And RBI has stated that they will be able to manage these outflows, and the effect may be only on the forex market. But that actually means that at some point we are going to have some large outflows, and these will keep the dollar rupee floor very well defined. And as I've been saying, closing above 80 to 20 for the last 3 sessions is put the rupee dollar on a firm footing for now, and immediate test would be at 80 to 50, and we will take it from there, because the FI flows have been slowing down in the last few days, and the stock market is also looking like correcting its rally. So unless we see very large capital inflows, I think even if it is there, we will be seeing the oil companies and the PSU banks absorbing them. So US dollar rupee looks like we are going to test the higher end of the range eventually, but it may be a gradual move and well managed move by the central bank, because they must be well prepared, having absorbed a lot of inflows and built up their reserves. Thank you.
Thank you, Jackie. And the US credit rating downgrade, it basically reflects the expected fiscal deterioration in the coming 3 years. We saw some rise in yields slightly yesterday, which was against market expectations, because the data with respect to PMI and job opening was lower than the previous month. So despite data from US with cooling inflation, yields haven't been going down because of the tight supply, because of all these issuances which the Treasury is doing. But basically, because of this downgrade, there can be a risk aversion which can lead to dollar being bought in the short term. From the emerging market currency basket, Chinese yuan, it rebounded strongly because the data from China isn't all that inspiring, and it seems that Chinese yuan is now again on the weakening path. And with respect to Japanese yen, which weakened a lot, so around 145 levels is something which the BOJ might try to use direct intervention. in front, when it comes to rupee, we were in a narrow range, and there are now increasing reports of repatriation of the rupee balances held by Russian entities, but RBI says that that can be well managed. So 80 to 20 was a good support which is being held, and we are seeing some buying from these levels. That's it from us today. Thank you so much for listening, and tune in tomorrow for another round of fresh updates. Thank you.